Thank you for joining me. I'm Gord Long. A reminder before we begin, do not trade from any of these slides. They're commentary, for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. I like to focus specifically on gold at least once a year, and it has been a while since we had that opportunity. With the focus increasingly shifting to whether inflation has peaked, and a looming recession bringing deflationary pressures, it therefore begs the question of whether gold has seen its better days and more downside is ahead. With the recent weakness in gold, there appears to be real merit in this thinking. In this session, I hope to answer what is going on with gold and what we might expect going forward. I envisage three coming unique stages, which we will outline. The bottom line is you will be given an opportunity in Q3 for an excellent entry price for gold before it leaves the station, potentially for major new highs. As such, I hope to cover the subjects listed here. Let's start with the current economic trend that's underway, or at least the Federal Reserve narrative it is promoting, which gold is reacting to and how they relate to the trade mechanics of gold. Remember, the Fed pumped the narrative that inflation was only transitory for a year and therefore doing nothing about it, before embarrassingly giving up on that mistaken belief. From a big picture perspective, we need to appreciate that gold follows yield. As you can see in this chart from 1964 to the late 1990s, gold followed yields as measured by the 10-year U.S. Treasury note. As the 10-year U.S. Treasury yields in blue rose, gold followed. When U.S. Treasury yield reversed, gold reversed and followed yield slower. I highlighted this era because it was a particularly volatile era. When the U.S. came off the gold standard in the early 70s, yields reached all-time highs during Volcker's Fed chairmanship during the early 80s, and when the U.S. rescinded the Glass-Steagall Act with the Gramm-Leach-Bliley Act of 1999. All were major events in yields and the real value of money. I won't take you through all the various swings in Fed yield policy over the decades, but the relationship is consistent. My colleague Richard Duncan does a masterful job of laying all this out in his latest missive, Gold, If Not Now, When? If you are not yet a subscriber, I encourage you to do so using the special Matasi discount code FLOWS, F-O-L-O-W-S. The net of Richard's work is that the Fed's shift to quantitative tightening, or QT, a rising Fed funds rate, and an overall fight against inflation is another major inflection in yields on the scale of 1975, 81, and 2016. All were bad for gold prices, as this one will also be, according to Richard. The resulting price drop in gold may be quite significant if the Fed in fact follows through on its stated monetary direction and plans. We'll come back to the Fed's plan a little later. Let's look at a more current correlation of yields versus gold. The chart covers the current 7-month period. We see on the left that the correlation held as usual until the Ukraine conflict, shown by the gray box. At that point, gold and yields separated fairly significantly. Gold surged on geopolitical risk while yields temporarily dropped. This ended in late April with a major drop in gold, which resulted in the correlation resuming, at least temporarily. On April 18th, a separation occurred again. This one was even more pronounced. Though yields were more or less within a trading range, gold fell hard and barely able to stay above 1800. The obvious question is why? Then we need to answer what is therefore likely to occur next. To answer that question, we must revisit some relational market mechanics. As we discussed, the 10-year U.S. Treasury yield on a big picture is driven by Fed monetary policies, as shown on the left. However, there are two components in what underpins the 10-year U.S. Treasury nominal value. We've discussed this many times in previous videos and newsletters. They are the inflation break-even and real rates. Our longtime subscribers are well aware the addition of the two equals the 10-year U.S. Treasury yield, which is the Fisher's equation, which we have shown to work very precisely. It is not an academic exercise. It works. What is important to understand is that gold acts differently with each of these components. When inflation break-evens go up, gold goes up. When real rates go up, gold goes down. This is at the core of what is causing the current divergence. Inflation break-evens and real rates can be quite volatile as they're driven by sentiment. Treasury yields have been historically less volatile. However, the Fisher equation says these two volatile drivers of gold must equal the less volatile movement of yields. This is what causes temporary distortions and divergences. Bear with me as we get into some detail so you can fully appreciate what is actually going on with gold and what therefore is likely to soon occur. Shown here is one of the two drivers of the pricing of gold, the 10-year break-even inflation rate. Shown by the red box, you can see that on Friday, June the 3rd, the break-even inflation rate closed at 2.74%. The red arrow highlights that starting on April 18th, the break-even rate fell quite dramatically from approximately 3% to 2.55%, or a 45 basis point drop. When inflation break-evens fall, gold goes down. That is precisely what happened. Gold started falling significantly on April 18th. The divergence and drop in gold continued until approximately May 13th. Let's now look at what happened to the other driver of gold, the 10-year U.S. Treasury real rate. You can see here that during the same period from April 18th to May 13th that the 10-year U.S. Treasury real rate rose from approximately 0 to positive 0.25%, or a 25 basis point rise. As you know, when real rates rise, then gold falls. That is exactly what happened, as both drivers of gold were forcing it down. However, they were offset for the U.S. Treasury yield, which is the addition of the two, forcing it into a more or less widening trading range. You can see that, as can be expected on Friday, June the 3rd, the addition of the U.S. Treasury break-even at 2.74 and the real rate at 18.8% gave us the U.S. Treasury nominal yield value as it closed at 2.93% for that date, exactly as the Fisher equation said it would. If we explode the May trading range of the 10-year U.S. Treasury yield, we see this technical chart. The range on this scale says the trend was down, though we can't be sure until we see this coming week's CPI and PPI prints later next week. We have the earmarks, according to LONGWave analysis, of a potential what they call complex combo correction, or simply zigzag, with a target of 2.5% labeled at the bottom before correcting upwards. Obviously, we can't be assured this will happen, but have added proof since this pattern is now appearing across multiple markets as a fractal signature, something we continuously look for in our work. What might all this mean? It suggests in the short term, or phase 1, we're likely to see 2.5 in the 10-year U.S. Treasury, as the CPI and June FOMC meetings might highlight that the Fed needs to be slightly less hawkish. We found hidden in the last FOMC minute, and not adequately covered, by the way, by the business media, was the fact that the Fed is leaning towards taking rates quickly to the neutral rates, but not necessarily any further. I suspect this will become clearer with this month's FOMC meeting on June 14th to 15th. I suspect it was also discussed when Chairman Powell was recently called to the White House. The Biden administration obviously is very concerned about the upcoming midterm fall elections and needs some economic relief going into them. There is a strong chance that gold therefore surges near term to 1940. You can see here that if yield headed towards 2.5% and gold rose to 1940 per ounce, the gap would be closed. We can be assured this will not work as we postulate, but we may at least be in the approximate ballpark if the historical correlation more closely converges in the short term. However, this is the short term over the next few weeks. What we are looking at in the intermediate term is whether, 1, the Fed will continue with quantitative tightening, and 2, whether we are likely to see falling year-over-year inflation comparisons appear as if inflation has peaked. These drivers, if they occur, will push gold down through at least Q3 2022. The technical gold chart shown here suggests this occurs until late Q3, then reverses with gold at lower levels. This would prove to be an excellent entry point. This is because it is our view and analysis that the Fed will be forced to reverse its current monetary policy direction narrative by then to avoid a serious looming recession. We feel this, in fact, is the current Fed plan and are only talking the market euphoria down. Therefore, gold will again align itself with the Fed monetary policies as quantitative tightening is halted. Gold will rise as the fight against inflation is effectively sidelined to fight collapsing growth, with liquidity expanding and financial conditions loosening. This sequence would complete our long-held view of the completion of a major cup and handle formation pattern in gold. We have found it interesting to see a sub-cup and handle fractal appear during this process. However, there is a lot more going on in gold than just Fed monetary policy, yields, break-evens, and technical patterns. We have significant developments on other areas which influence gold. One of those is the mechanics of a changing supply and demand curve. Central banks are now buying gold in a major way. This is a big shift and is being accelerated by the further U.S. weaponizing of the U.S. dollar with its sanctions against Russia and its Russia's central bank. Countries are moving more of their FX reserves into a neutral holding of gold, not to be caught between a coming potential Cold War II between the West and a China-Russia-aligned commodity-based consortium of countries. We are seeing more global growth in gold holding within ETFs and from active money managers trying to diversify portfolios. We are seeing growth in gold ETFs themselves as a percentage of overall U.S. and global holdings. Demand is growing rapidly. Meanwhile, supply has not kept up and is highly likely to get worse due to an overall lack of investment. The costs to bring new production online have skyrocketed and continue to discourage any sort of capital investment. Exploration costs are through the roof. Licensing, zoning, regulatory costs are huge and increasingly problematic and restrictive. Physical construction of bringing a new site online are going up exponentially. Production costs associated with labor, material, taxes, etc. have recently become problematic. Distribution costs are stripping razor-thin margins, and the time to get a new mine operational can easily take a decade. All of this has led to poor investment to match growing demand. Miners are more or less just waiting for the inevitable to occur. Presently, all-in sustaining costs in the 17 to 1900 range, fairly close to what gold is actually trading at. But the production costs of major producers, as we mentioned, are exploding. We should expect, therefore, gold to simply rise, like all commodities, from energy to food to housing. 40% price increases are not at all unlikely based on what we are seeing with other commodities. And this assumes, longer term, sustained supply shortages don't squeeze gold even much higher. There are also other emerging drivers of gold. Commodities as an asset class is in the early stages of its own supercycle. We have chronicled this over the last couple of years and is now becoming obvious to the investment community. Gold, like silver, performs both as money and as a commodity. Gold is still a misunderstood investment. Any real changing attention given to it, because of its relatively small participation in modern portfolio management, will be profound. Gold used to be a geopolitical hedge. This only recently showed itself again with the Ukraine conflict. We can be sure of increasing and more dangerous geopolitical conflicts going forward. More professional investment managers are increasingly adding gold to portfolio diversification and balancing strategies. Fiat currencies are now under attack as China and Russia move towards increasingly supporting their currencies with hard asset backing. Stagflation and slowing growth can be expected to foster increasing allocations towards value versus growth. And never forget that gold is money in troubling and uncertain times. Uncertainty and shortages foster the growth in dark money and black markets. Expect them, which will itself pressure gold prices. What can we conclude? Gold is both a commodity and money. A whole generation, or at least two, will soon rediscover this during this unfolding decade. Fiat currencies is a relatively new phenomenon that has endured during an unusual stable times since the end of World War II. Fiat currencies have never proven themselves as viable over the long run. Fiat currencies are prone to collapse because they are founded on the belief and faith in governments. When that faith is shaken, people historically look for something they can trust. This doesn't mean fiat currencies are going away, just people's confidence in them is. Investors can be expected to seek protection from this shift. Precious metals are the proven strategy for this justified fear. That, at the margin, is going to make a big difference. No one knows with certainty where gold is headed, but I don't think the well-researched and highly knowledgeable professionals at an incrementum shown here are too far off. $5,000 per ounce by the end of the decade is certainly a possibility. Selling at lower than current production costs is not a possibility. Just ask yourself, what has this sort of certainty of upside with so little downside? As I always remind you in these videos, remember, politicians and central banks will print the money to solve any and all problems until such time as no one will actually take the money or it of no value. That day is still in the future, so take advantage of the opportunities as they currently exist. Investing is always easier when you know with relative certainty how the powers to be will react. Your chances of success go up dramatically. The powers to be are now effectively trapped by policies of fiat currencies, unsound money, political polarization, and global policy paralysis. I'd like to take a moment as a reminder, do not trade from any of these slides. They're for educational and discussion purposes only. As negative as these comments often are, there has seldom actually been a better time for investing. However, it requires careful analysis and not necessarily following what has traditionally been the true and tried approaches. Do your reading and make sure you have a knowledgeable and well-informed financial advisor. So until we talk again, may 2022 turn out to be an outstanding investment year for you and your family. And I sincerely thank you for listening.